Hello, everyone. Thank you for joining us. Today, we're very excited to have Doug Garber, who is the founder of Pitch the PM and Westport Alpha, to talk about the NVIDIA's stock outlook. Before that, just some housekeeping stuff. We definitely have disclosures. This session is for education purposes only, and this is not a financial advice. If you have any questions, feel free to ask the questions on the Zoom panel, and we'll be taking your questions while during the presentation as well as during the Q&A session. With that, let me just take a few minutes to introduce my co-founders here from hScore, Mark Rhodes and Hari Kusumakar. Quick 2 minutes on what hScore is. hScore is an AI-based application that we have developed to help the DIY investors conduct equity research, portfolio construction, portfolio management, idea generation in a quick steps. The basic problem that DIY investors today face, which compared to the professionals, is what to buy and sell. In other words, research, when to buy and sell, and how much to buy and sell. That is what we are solving for. The way we have solved this, we have personalized ratings called hScores, which are on a scale of 0 to 1,000. Higher the score, the better it is for stocks, ETFs, and portfolios. Then we have personalized idea screens, which you can do custom screening or AI generated, as well as we have a portfolio optimizer, which helps you make exact buy and sell decisions with the correct amounts. The way we do this is we have custom rating for every stock, which is personalized to your mandate of return, safety, and income. What you see on the screen here is a return score, safety score, and income score for NVIDIA. And along with that is your priorities, 45% for return, 45% for safety, and 10% for, let's say, income. For a balanced investor, that gives you an hScore of 530, which in our view is an average score for a balanced investor. Not only that, we'll also give you what are the drivers of those returns, which in this case, as you can see, earnings growth is one of the biggest drivers. Volatility, which works both ways, helps the return of NVIDIA, but the valuation appeal is hurting NVIDIA at this point, given the expensive nature of the stock. In addition to that, we also give you the reliability of the scores. Any score reliability, which is medium or high, it can be relied upon. Then, because we have the custom hScores, you can use those hScores to find new ideas and create idea velocity in your portfolio. These could be either AI-powered preset screeners or custom search criteria, and that will give you the new ideas based on best to worst, right? So now that idea generation for you as a user is more customized than one size fits all. In addition to that, we have an optimizer built in, which gives you the best buy and sell decisions while satisfying many goals that you might have in your portfolio. And those are custom settings. Again, this is an optimizer customized just for you, and which will give you the optimal portfolio in a few clicks. This is a representation of what it would look like. It not only gives you the buy and sell decisions, it gives you the exact amounts, but also it gives you an impact of what it does to your portfolio if you were to make those decisions in your portfolio. With that, this is the team that is working on hScore, a solid finance team from ex-hedge funds like Citadel, Tiger, and also a tech team which has successfully exited startups before. With that, I'm going to hand over to Doug now. Let me first introduce Doug. Doug and I go long back from our Citadel days. As a matter of fact, I've known Doug while he was at the sell side as well. I used to use his research. Clearly, he's made a great career, both at Citadel and Millennium. He's also the founder of Pitch the PM and Westport Alpha. I'm personally a subscriber of his newsletters. A lot of interesting stuff. Investing can get boring, but his stuff is actually very interesting. Good read, casual read, as well as a lot of insights that you can get from his newsletter. So would encourage all of you to subscribe for his newsletter. With that, Doug, why don't you introduce yourself to the listeners here, and then we can get into the presentation.
Yeah, thanks Saket, and thanks Mark and Harry for having me. Yeah, I've known Socket since our Citadel days and before that, so probably 20 years. I spent 10 years on the sell side at kind of mid-market banks, FBR and Dahlman Rose, kind of reading 10Ks and modeling, and then I got picked off to go to Citadel for about 6 years. Worked on a couple teams there, managed as much as $1 billion on a $2.5 billion team. And then I was in the process of spinning my own team out. Then I went over to Millennium and did it there. It was just a little easier fit at that point in my career. And built a team. We did a bunch of sectors. We ended up having a couple sub portfolio managers and running a little bit of risk. So we had a couple uncorrelated revenue streams in different sectors doing. We even had a capital markets team strategy as well. So we kind of expanded over a few years. And then actually I took a year and in the work from home, moved out to the burbs and worked from home did IR for a tech company over in Israel. So I actually been in all three seats, IR, sell side and buy side. And I actually think everyone should do the corporate IR thing for at least a year. And now since then, I've just been investing myself. Westport Alpha is the vehicle for that. Sometimes we do kind of SPVs or special situation investing. And then Pitch the PM is something I started about 6 months ago. It's just a way for me to kind of talk about the process or the ideas I'm having with colleagues and to kind of put it through the process. I found that most people I talk to, I'll always have conversations with colleagues like Saka and everyone, people will generally give me one or two sentences of why they like a stock, but no one actually goes through the entire process. So it's a way for me to keep my process accountable. It's the accumulation of things I've learned throughout my career from the sell side to Citadel to Millennium and then after. It actually started when I was at Citadel. My PM worked, the first guy I was trained by, he came from SAC or Point 72. And and he started off with this is the process he had. He worked for Stevie. He goes, all right, this is how we're gonna do it. And then we've been refining it every year or so since then. And this is where my process currently stands. And essentially it's a checklist of questions that I think people should look at. And I apply those kind of 10 questions through stocks so I can think through, you do the research, where do I start? And it's designed for it. If you're going to walk into your boss's office, whether it's Saka or Steve Cohen, what do you want him to do, and go through the list. And it's important to have a process, whether it's a quantitative process like hScore or more of a fundamental qualitative process like I do here. You gotta have a process and you gotta stick to it. That's this way when things go south, you know what to do. So NVIDIA is one. I'm not originally a semiconductor analyst, but I have been researching it since last summer now. So it's been about a year. And I've done probably 15, 20 posts. I'm kind of sharing the research as I go on LinkedIn. So follow me at Doug Garber. And then I actually did a post. You could go to my old post. I did one last week, last Thursday, ahead of this, showing all the work I've done on NVIDIA, all the different posts and how it's changed throughout there. So NVIDIA, obviously they make, semiconductors, they make the GPU, which originally was for gaming, super efficient, and they were in the right place at the right time in terms of processing when AI took off. Before that, they were also doing a lot of crypto for the GPU, and it's essentially exploded with AI, the demand, right? And the stock and the earnings revisions have moved with it. So when people say AI bubble, I'm like, well, NVIDIA, it's not like it's at 30 times revenue, it's at 28 times earnings. And the stock has moved historically. And we'll get to this slide. I'll share some slides here. We'll go through them. And we'll go through some of the slides. And what you kind of see eventually, so obviously it's a huge company. We'll start on the first one. Like the whole thought is, what's priced in? Obviously 3 trillion market cap, no net debt, huge liquidity. I'll just go through the checklist. We'll come back to the checklist, make sure I get to everything. And so I'm going to go to that 10-point checklist, and we'll talk about why revisions are important for NVIDIA. So that's who I am. I'm really a researcher at heart. I ended up running Katahdin Capital is part of Millennium, Citadel for 6 years. NVIDIA is 6-7% of the S&P. So any index, everyone owns it. The question is, are you overweight or underweight or short it? I tend to think everyone has a bias, so you always got to think about what their bias is. I'll tell you right now, I have a short position. That said, I'm trying to be intellectually honest and say, what are the facts here? Most people obviously own it. There's not a lot of short interest, so you want to maybe just know what the bear side is. I try to know both sides and then pick. That's how I think about it. What does the long person think? Because every day there's people buying and selling. That's what makes the market. And everyone has different perspectives too. Whether you're playing for a quarter or you want to hold it because it's a compounder over time. I also found that people, if it's done well for them, it's already, been a 6, 7, 8x, return in the last couple of years. People are happy with it. They've done well. They get complacent. Whereas if you missed it, you might be like a little negative on it. So I do have a short position. I did when it got down to like, about $100 or so. I did start to sold some puts there as well. So I kind of like, all right, this is, so it gets put to me at $80-$90. I'd essentially be all right with that. So that's just and this is not investment advice. I'm not, you got to see what's appropriate for you and your financial advisor. That's not what I'm here to do. I'm here just to educate, as Saket said, from a disclosure perspective, but do like to kind of always know what people's bias is ahead of time.
Hey, Doug, just
Yep.
quickly, just for all the listeners on the call, please post your questions in the Q&A section, and we'll get it answered. Thank you.
Yeah. So, Jensen obviously has done an amazing job. He's essentially bet big 3 times and won, right? He bet on the GPU and he won. He bet on the CUDA, surrounding it with CUDA software, and that was a win. And then he essentially also put in the networking around it. So he really owned the data center, not almost 90% plus share, and essentially collecting all the rent in the AI ecosystem at this point, is really going to NVIDIA. The data centers are the returns. I haven't seen any free cash flow. Let's just put it that way. And even the cloud providers are paying a lot, right? 75% gross margins. I think that's the key thing here with NVIDIA is what are the gross margins, and then what's priced in, right? There's no doubt this is a great company in a growth industry with a great free cash flow profile, great returns on capital, great competitive advantage. When I look at a stock, I tend to think about what are their customers doing? What are the returns of their customers? And when I went down that rabbit hole, I see a lot of money funneling into the AI ecosystem. Probably a little bit more speculative than fundamental. They're not actually getting a return on capital yet. In terms of a cash on cash return, they're investing early, right? You have this arms race where no one wants to miss out. And you've seen that in whether it's Musk or Zuckerberg, they're just spending. You've seen a little bit of a, as the big customers, the big 3 tech companies, Microsoft and Amazon and Google, as their stock starts to decline, people want more capital discipline. So you've started to see, their CapEx has ramped up tremendously, and that's essentially coincided because those 3 customers are about half of NVIDIA's demand. And then, the other part is, China, Asia is a quarter of demand, right? Some people say there's more than that, 30-40% if you count what goes to Singapore and then goes through intermediaries to China. That's the higher end stuff that's not supposed to. So there's obviously China risk. We had a scare and then that came back. That seems like that's okay now. They took a big write-off. So, NVIDIA sells them lower quality, not the best chips, but other chips they make specifically for the Chinese market. So coming back to, the credibility here, obviously Jensen has tremendous credibility. He's worth billions of dollars. And he's one of the great entrepreneurs, of our time, and he's really done well. And he's a lot of credibility. Anything he says, people really listen to. And, I've also been in the IR seat, so I kind of see some of the narratives they get, every time you got to make the TAM a little bit bigger, right? So the story keeps working. I've also said, all right, well, why do they only give a quarter guidance, like 1 quarter ahead? I'm like, Vertiv, who makes data centers, they give a whole year of visibility of guidance. Their customers give guidance for a year on CapEx. So I didn't really add up to me on why they only give a quarter of guidance. Now, the current market, you kind of think about it right now, the supply and demand. So I try and dig into the supply and demand of GPUs. And right now, the market's still pretty tight, right? The question is, will it always be this tight where they're able to get this much pricing? I tend to think, as Howard Marks would say, everything's always cyclical at the end of the day. But right now, we're still in a tight market. So the other thing is, do I understand this business? So I've been doing research for almost a year on it. You know, I have my mental model personally is everything is cyclical. That's some people say, hey, this is a secular win-in, this is technology, and it's secular. I tend to cringe when people say secular because I come from more of a cyclical background. And I also, you know, I put Howard Marks's quote in there because he, well, you know, he has more credibility than me on things being cyclical. He's been doing it for like 44, 45 years probably. So that's kind of in my mental model. Some people have different mental models. And then I go put everything through this 10-step variant view process, which is what we're going to go through. And I also focus on, you know, not just the supply and demand of GPUs, but also what's the leading edge price doing. But then there's also non-fundamentally the supply and demand of the stock, and then the supply and demand of, well, we're seeing in stocks like CoreWeave, like the supply and demand of the borrow of the stock, which is a whole nother situation. But I try to stick to the fundamental. What is the supply and demand of GPUs at the customer level, and what's leading edge pricing doing? So I kind of try and get into that market. So here's the 10-step variant view checklist. We're going to go through these 10 at the end. We rank them, kind of thumbs up, sideways, or down. So we're going to go a little bit out of order here, but you know, what is it worth if, you know, the bet is you know, this was designed for like a short bet, but you know, one of the things with NVIDIA that I thought was the expectations were so high. And sometimes the street plays a game where they're like, all right, they want to be bullish, they want to be more bullish. But if you think about the growth rate coming out of NVIDIA, for the stock to work, they need to not just hit expectations, but beat them. Right? The stocks move, my kind of North Star rule of thumb, stocks move with revisions. And for the stock to go up, you need positive revisions. What's happened the last 3 quarters on NVIDIA is actually the stock has beaten, but only by a little, and the stock's gone down because people are starting to see concerns. And that's where you kind of see the cyclical top. People are getting more concerned about, all right, how long is this going to last? Now, obviously, NVIDIA paints the picture of, you know, TAM's $1 trillion. We can grow at 20% for a long time. And everyone, you know, kind of puts the year-over-year growth rates in there. And obviously, we have great growth rates announced last year with the CapEx from the hyperscalers. But if you look sequentially, that's starting to slow. It's still growing, but at a much slower rate. And then if you kind of compare the numbers of the CapEx, now there's other things in the CapEx, but the way NVIDIA was modeled, the sell side has modeled it just essentially growing $4 billion a quarter of revenue. Whereas if you look at the CapEx, it starts to flatten out. So I think the street's a little ahead of themselves. I think revenue is still growing, but at a slower pace. And I think supply, there's competition. I mean, people know, you know, Amazon, Google launched their own chips. Microsoft's trying as well. You know, last year where they, you know, they're paying a lot for the NVIDIA chips. So they're going to be ramping up their own. They also have the Chinese. And you've seen some people say, you know, ever since DeepSeek and in China, you're saying, hey, we don't need as many GPUs because our models are more efficient. So you are seeing technology try to reduce demand, and you are seeing demand obviously grow, you know, exponentially. At the same time, people are becoming more efficient. So, and the other thing, you know, you got to realize here is Bitcoin uses about a quarter of GPU demand. So it depends on your view on crypto. Probably fine for this administration, but longer term, you know, what's it worth? You can have your own opinion. You know, obviously Buffett has his opinion that it's not worth anything. So if you want a bear case, you kind of look at, you know, the low on the street called $4 in 27. Now that's a fiscal year, so that's a calendar year 26. Yeah, you could say, all right, 15 to 20. Now the street's probably at 560 or so. And you know, the street bear case, bolt base case is going to be 170 or 180. So But if you think that they're not going to hit their numbers and margins start rolling at some point, which is my thought process, hard to predict when, but I do see competition coming. I see customers that are spending, but they're not necessarily getting a great return. All right, so then there's the bull case. Obviously, we talked about the TAM, right? The $1 trillion TAM. You kind of can keep growing for a long time, and still get the margins. You're getting credit for volume growth and margin growth. And then you need big tech to keep increasing their CapEx. And I don't know that they're going to keep increasing their CapEx at these rates. I mean, even if they kept it at these levels, that's very high levels. They've all gone from kind of capital light models, software companies, to now they're building putting a lot of cement in the ground, a lot of data centers, a lot more CapEx. And Microsoft's one of the leaders, you talk about for that. Now there's also the demand that the train and inference side is 100 times more intensive. So, and the company still outlines, more TAM they kind of grow the TAM. But here it's interesting. We're not even talking TAM. We're talking use cases, which is like, we can't even quantify the TAM, so we're just going to call it use cases. The other part of it is obviously this is obviously a great company, high margins, high net income, great returns on capital, and they're the leaders in their field, and it's a growing industry. So there's definitely a lot of good things going on. My thought is, one, the people are ahead of themselves in the growth rate, and the second thing is their customers are more speculating than investing. And there's kind of animal spirits and arms races, which is a little bit inefficient. So that level of CapEx is not necessarily fundamentally supported, but that's how the capital markets work. So, there is currently a chip shortage. There's talk about CUDA, that's the barrier to entry, the software. There's definitely people trying to get around that. You've heard that from new models in China. You've heard obviously there's great engineers, at these other firms too, who are, they compete with software companies. So, but it is harder to, one thing to have that, Google and Amazon have the chips internally. It's another thing to go sell to someone else and warranty it to another data center and support it. So you'd call the bull case here, consensus 570 on 27 fiscal year 26, 30 times has kind of been the average. You get to 170. So that's kind of the range of outcomes here, the bull or the bear, and you kind of say, which one do you believe at the end of the day? So when you go to kind of, do I understand the business? NVIDIA, obviously 90% share. If you count how much Google and Amazon use internally, 70-80%, they're the gold standard. AMD is really falling behind here. There's Huawei over in China. That's kind of the real competition. Amazon and Google, have their own for internal use. I think Amazon's on version number 8. Google, I don't know, they have their TPU. So they are starting to have other people use it, starting in the back half of last year. There's also been some chatter. I've done this interview with this Hydra host private guy, and what they kind of said was that some of those deals, the only reason they're using those chips is because they did a package deal with NVIDIA's chips because they're more efficient. So the other chips are cheaper, but they don't get as many what's called flops per. They're not, you don't get as much output out of them, so it doesn't matter that they're cheaper. You're still paying more per output unit. And then Microsoft's playing catch up too. Microsoft has units as well that they're starting to offer externally. They're a little further behind. And then there's other people who are doing GPUs. Cerberus, they're kind of designed it for inference. So there's competition coming, whereas before NVIDIA was the only game in town. They're still the leader in the race by far, but there are other people coming in now. That's not something that's going to change overnight, but it's their lead. It's they're ahead of the race. So it's there's people coming at them. It's mostly because the CapEx numbers coming out of the hyperscalers is so big at 75% gross margin. Put some money in it so you don't give them all the the CapEx that's going to hurt your return on capital. So we did an episode with the folks over at DA Davidson too, and this is NVIDIA's growth, their revenue growth, and what you see is obviously it took off post-COVID with the AI trade, but you also see there are times of cyclicality in semis. Even when they're great companies, you have some other, great companies in there that there's still a little bit of cyclicality, even if you're just continuing to earn above your cost of capital. So that's kind of here shows you their growth's been amazing, but the growth in earnings again has been moved mostly with the stock price. It hasn't all been multiple expansion. In fact, it's been earnings revision. So that to me tells me it's fundamental. It's not necessarily a bubble at NVIDIA level, but what is a little bit, I call it some hot air in the system, is that their customers a lot of people are giving their customers money to experiment that aren't, some are getting returns, some aren't, and they're all just trying to get in the race. And that's what concerns me. It's not like their customers are all making a 10-20% return on capital. They're all burning money based on a PowerPoint deck. So do I understand the business? Record growth is expected. I kind of said, you just kind of look at it from a high level, right? Consensus expects revenue to go from 60 billion in 24 to nearly 300 billion in 28 in 4 years. All right, well, Apple did that. It took them 5 years, and Amazon, it took 8 years. So that's what I'm talking about when I say the growth expectation is it's a pretty high slope. Like this blue line's a much higher slope. So that's the issue for me. All right. And then one of the big things is always what's the evidence. And I use some other AI tools just of other people kind of getting into the business. Who's using, what's Google using? Who are their new customers? Why are the customers using them? So you can kind of collect that. You got to kind of do the research, read other companies' transcripts. The most important thing is really doing customer, getting into the channel and doing customer research. That's usually the key for me. So that's just kind of who's using the competitors' chips here. And then this chart we're just talking about, what we've talked about here is the homegrown, the hyperscalers, what are they doing to compete? You see Google, they're the TPU, they're introducing their next version. You have AWS, Trainium, and they're further along. This is where they have these chips deployed in their footprint. Microsoft doesn't really, they're a little further behind. So there's competition coming. But again, there is tremendous growth, so there's room for both, but it's not, all I used to hear on TV is, my old colleague Dan Ives saying, all right, NVIDIA is the only game in town. They are still the best game in town. They're not the only game in town, is what I would say. And then you get kind of a little more technical here. Is just kind of this is some of the Chinese data. There's some technical papers talking about flops for different chips on some of the Chinese stuff. And it's actually saying some of their flops are just as efficient as some of NVIDIA stuff. Now, some other people have said about the Chinese stuff is it's not as efficient, and they are a year or two behind. But what's happening is they're so cheap you can use a couple of them. So, and their energy is cheaper there too. So I did try to go into some of these technical papers, but that's probably a little too much. All right, so then there's obviously the stock chart here. I always like to just look at that at some point, and I tend not to buy stock charts up into the right. We did have a nice pullback here on the China concerns, on the recession concerns, and it's come back here. And yeah, so you kind of, it's been a great run, obviously, the last few years going from, call it, $20 to 130 in two years. So I also look at the valuation. The valuation is not actually crazy if you look at the next 12-month PE. In this company, the PE is pretty close to free cash, so it's actually not really playing games, which I like. And the company actually generates a lot of free cash because they don't have a lot of CapEx, so it's good. They're just sitting on it and doing some buybacks, I guess, with it. But the average multiple, 26.5 or so. It's relatively low actually versus history. I think it's 27 or 28 the last couple of days since I put this together. So the average is 36. Now you're getting a 36 multiple, A, high return on capital, B, expectation of really strong growth. The growth expectation is coming down. It's just law of big numbers, right? It might have done 50%, now it's going to go to 20 or 30%. But again, people are looking year over year, not sequential.
Hey, Doug,
Yeah.
We have a question where people are asking about a comparison with the Google TPUs versus NVIDIA GPUs. Any thoughts there?
Um, yeah, I mean, the NVIDIA is there's certain cases where people will argue that the Google one's better for this or that, for certain instances, but NVIDIA is the clear, they're the gold standard. They still are. They're more efficient. Um, and different research, you'll definitely get these anecdotes of people using them, the Google ones, the TPUs. But what they don't tell you is they probably did a package deal and also got NVIDIA chips with that. Now, there are also times where there's certain workloads that it might be more custom designed for. Now, Google's also interesting because Google uses a lot of stuff internally themselves. And then they also have their cloud where they offer these services compute to other people. So, yeah, I mean, they're trying to close, they're a big consumer and they're trying to close the gap so they don't have to pay 75% margins. NVIDIA is ahead of them and years of iteration. But they kind of make, the chip that's good for everything. If you customize, eventually you put the software in the right people, they're going to catch up if you put enough money behind it. That's my thought. Some people think NVIDIA is gonna, they're gonna be the best forever. I mean, obviously, Google's not. I think Google. I did a check. One of the former Google engineers said, our goal in 7 or 8 years is to be half NVIDIA, half internal Google chips, and they're ramping up their production. So they are making strides to use more of their own chips versus the NVIDIA chips, because it's a lot cheaper, right? So they just have to prove it and do it, right? They're going down that road because they're economically incentivized. Um, but right now, NVIDIA is better, is what I would say, and Google's trying to make an inroad.
Yeah. One thing to note here is that the huge customer concentration for NVIDIA in general in their business model looks like their top 5, 6, 7 customers, they're probably 40 to 50% of their revenues. It just like I have been a
Top
generalist,
four.
I've covered a lot of companies in my career. This just seems like a really, really concentrated business model where even
Mhm.
one client's plans change and you're really going to struggle.
Yeah, I mean, I think that
Thoughts on
the
that?
one, yeah, I think you're right. It is. If you add Facebook to the three hyperscalers of Amazon, Microsoft, and Google, those four are about 50%. And we're all talking. I mean, the GPU is, most of NVIDIA's business. They have other business too, but yeah. So I think it is a risk, but I think the other side and those customers are the same ones adding their own chips. Now their demand's grown, so they have room for both. That's one of the concerns. The other, what the bulls would say is, well, Microsoft's or Google's not the end user, it's all their customers. And they're the ones who wanted the NVIDIA thing. And then there's the argument that, that they could sell more to the data center guys because they want any of all these data center companies who are going to try and compete with the hyperscalers. So whoever gets the GPUs from NVIDIA, like CoreWeave gets them, so now they have a business. So whoever if they didn't sell them, that's kind of the asset right now, because that's the key thing people want is the NVIDIA chip. Um, but yeah, that's a tricky spot to be in when your big customers are also now your competitors, and there's concentration. But right now there's excess, they have demand, right? Everyone wants these, the so yeah, it's a good question though. All right, and then I also just do the valuation on free to cash flow and EBITDA, same thing, same source story where it's relatively low, below history, because the growth is slowing. Um, I also look at it relative to the market. So you look here and it's historically been a lot more expensive versus the market than it is now, because it has good returns, better growth prospects. Historically it would be, two-ish times. Now it's 1.2 times. So you're getting a great company, good returns, because people are saying, what's the sustainability of this? That's starting to come into the stock now. When you see the multiples come down, that's kind of what it tells you. So why is it mispriced?
That just on the previous chart talking about the multiple, right? So if you look at NVIDIA's growth profile, it's going to maybe 10%, 12% earnings growth 2 years down the line, right? If you think about it, at that point, it's basically an S&P 500 type looking company. Even if the current expectations hold, then the question is what multiple it should trade at that point. And if you look at S&P 500 multiple, it should maybe 17, 18 has been a fair multiple historically. Maybe even in an inflated world we are in right now, 18, 19, 20, 21, 22 is probably where it is as good as it gets. And we're still at 28. So there is a substantial, as we just go through time, there's still a multiple compression potential. We look at $6 EPS 2026, even if you put a 30 multiple on it, right? That's $180 stock in the best case. And we are at 135. So it's not like the upside is huge relative to other good tech stocks out there. Like just I was thinking about where things are right now. What's your thoughts on that type of thought process?
Yeah, I mean, I generally agree with that there's not that much upside, and because the multiple is decent and really the growth expectations. I guess the whole premise is what I'm saying is making an argument that it should be at a 28 multiple or an 18 multiple. I'm not sure I'm going to ever win that, but what I cannot win is earnings revisions. I try to focus on that, right? And the stocks moved 6, 7x because earnings have moved 6, 7x, the forward revisions. You could argue that they obviously have a better end market. They've essentially 80, 90% share. They've got great returns on capital. Maybe they should get a higher multiple, right? People like AI. So there's a lot of reasons you could argue for a multiple. So I try to focus more on the revisions than the multiple. But it's a different story when it's at a 17 multiple versus at a 28 multiple, your risk reward and your entry point. But I try to say, all right, well, let's think about where are we in the grand scheme of the cycle. So, why is it mispriced? I tend to think AI is pretty hyped. Overall, I mean, I am a believer that it'll be a productivity tool. I use it. I just think the value is going to kind of start to accrete to people who are able to deploy the AI and help and charge and get people to be more productive and actually utilize the AI versus in the beginning of the cycle, as anyone who had access to the chips, and that's still like kind of the constraint, and that was the initial growth, but now it's going to kind of, and the big thing here is like, all right, NVIDIA's making 70-75% margins. That's amazing. And semis 50-60 would still be amazing. But the stocks market's not going to like it if all of a sudden there's competition, they lower the price so that their data center guys can make a little bit of margin, because right now they're not. So they're really eating all the rent. And you got to buy into TAM and use cases. I don't generally buy in when I hear TAM and use cases. I did that during COVID. I mean, people are like, all right, we'll grow 20% forever. And, I was IR at Fiverr, that's the story, but I make up this big TAM and we grow 20% forever. And TAM is just a story that people make up so you can believe you can keep growing 20%. At the end of the day, I tend to think cyclical versus secular, but all right. All right. So this is
We have one more good question from Ajay Bora. He's saying the 40 billion cash pile that they have, is there any value to it, let's say in terms of M&A potential, and maybe the stock looks different if they do something and it's not a $6 earnings in 2026, maybe it's something more.
Yes, the 40 billion is definitely an asset. They also have a large amount of obviously capacity to borrow if they want to do something. So yes, yeah, there's always M&A. You have no idea if it's going to be accretive or not, or strategic. It's a $3 trillion name, so 40 billion. I don't know if that's really moving the needle.
One thing to be cognizant is that this type of business, you do need a lot of cash just to run your business. It's R&D focused business, so not all of that 40 billion can be deployed towards M&A. It's probably going to be, let's say, roughly maybe 10, 15, even if for an aggressive CFO, somewhere in that range, they'll still want to have a big cash pile for this type of business, which doesn't have a forecast of more than a quarter in their guidance, right? This is not a recurring business model. So
yeah, that's true. I mean, software is a small part of it. Yeah, I mean, they've more than enough money. I don't think M&A is going to move the needle at this point for something this big. I mean, they have started to talk about net data centers, like, start to compete, but that's more capital intensive. That would change the model. But I don't think M&A would be it's not a core part of my thesis either way. So this is what I've been talking about for, last 2 years. Earnings have been revised up from, call it 60 cents to 450, 7x, and stock went up. When I did this, 6x, now it's probably back to 7. It is closer to 7x. So it's been logical, right? Numbers move with forward revisions, and the numbers, the numbers are going to tell the story at the end of the day. And I was also talking about the last quarter where earnings still got revised up a little. The stock was down, and to me, in my cyclical mental models, that's usually a little bit of a concern when you see, positive revisions and the people aren't rewarding it. They're saying, all right, how sustainable is it? But
Another question we have is about margin forecast. Like you said, these guys are making 70 plus gross margins, and in
Mhm.
semis, even 50 is like really, really good. So even if they become from great to really, really good, that's just one third downside of the earnings potential, just from, let's say, margin going to 75 to 50. In terms of catalyst or something, do you have any sense when they'll stop over earning and maybe earn more like a regular business?
yeah, I mean, I think they were doing it in the 60s before kind of this, the last few years where they had this tremendous demand and shortage. They're so they have the most efficient product and they're in demand, so they're able to charge a premium for it. That's the key. That's the magic question: is when does either competition start coming in? When does when is the pressure from other buyers say we need a lower price to make it work? When do the customers say we need to get a return? I don't really have a exact roadmap. I mean, it sounds logical that you're not going to sustain 75% gross margins forever. Um, right now the street kind of believes that, and right now things are short, so I don't see that. I don't expect us, to have a wake up tomorrow and have it. There was actually a little bit of talk of going down a couple points on startup, but the market's still tight. But I think at some point margins. I don't know when, but it makes logical sense to me that at some point margins probably won't be in the 70s forever in perpetuity, I would say.
Another consistent theme in the Q&A we are getting is some kind of huge upside potential not baked in because of all these sovereign deals people are striking. Do you have any thoughts on that? Looks like the revenue trajectory is huge already and in a non-recurring business model. So it's really hard to quantify, but we would love to hear your thoughts on that.
Good PR for the White House. You know, I'm not sure that's fundamental demand. I mean, build the data centers, and they're definitely part of the equation. And we talk about sovereigns being a small piece of the pie. But even if they have their own data center, they're going to get a return on having a data center there. Who's using it, right? So we did talk about that. And I did an episode with Gil Loria about that. I mean, those are not great episodes where, all right, now we're going to go and spread the NVIDIA chips like the Bowen plane all over the world and not let, China do it. So it is an incremental positive. I don't know exactly what the numbers are. And, it could be like PR headline numbers, and then what are the actual real numbers, and then what are the real numbers per year. So I haven't quantified it. It's definitely a good story and probably some fundamental layered in positive, but I don't know the actual number on it. So it's a good question though. All right, so I mean, if we could do more, questions, that's always good. So we have mispriced, variant view. One of the things I do talk about is I started talking about this earlier, but like the consensus expectations, right? The consensus is NVIDIA growing revenue $4 billion per quarter. And if you take the CapEx from those top customers, it's not growing that fast. So they're gonna have to take a lot higher percentage of those customers' spend has to come to NVIDIA where before. So that was one of my concerns. And yeah. And then you also kind of dig into the channel, and you saw a year or two ago the GPU, it's kind of, you rent it per the hour. Sometimes it could be $7 or $8. Now it's $2. Now they get the newer models and there's a depreciation curve, but things are not as tight in the market, in the spot market, that people actually buying it. So obviously everyone's bullish. There's now one sell rating. The guys over at Seaport now have a sell. When I started the research, there were 0 sells. That's always a flag to me. I'm like, oh, everyone loves this thing. Now, they're banks. They want to get the other AI deals. I get it, but it was almost 87% buy. So kind of quote Buffett, be fearful when others are greedy. It's kind of everyone's already on this name, right? It's kind of like fish somewhere else is kind of how I think about it. Talk a little bit about, Microsoft kind of had a little bit more pressure on their ROIC. One of the things I did is I went to the other public neoclouds, CoreWeave and Nebius, and I really couldn't figure out what their ROA, and these are the bigger ones, like what's their return. I'm not really seeing a good return on capital when I dig through their financials. I'm looking historically, but it's like, show me the return on capital for your customers. I know they're buying them, but what's their return? And then what's their customers' return? So, there's money flowing into data centers and everyone wants these chips, but I tend to think more logically, like, if you get a good return, you spend. Like, otherwise it's a little bit of hot air. All right, so this is the quarter-over-quarter revenue stuff I've been talking about. So revenue has been increasing about 4.6 billion per quarter for the last 7 quarters. Pretty impressive growth rate. And the street models, guess what? Another 4.8 billion per quarter increase for the next 4 quarters. It's kind of friend is your trend model, and that's kind of how it works in Excel when I've done this, right? I guess Buffett would say, the forecast tells you something, tells you nothing about the company, tells you something about the forecaster. So yeah, they just kind of go with 4 billion a quarter. So that's the revenue. And then you look at the growth rate of the top 4 customers, 50% of the base. So we just saw all these headlines come out at the end of Q4, 50, 60% year-over-year growth. That was kind of what everyone got excited about. And then, they got excited about that's what we saw in 24. This year, we still saw huge numbers, like you're still seeing 34% growth and year-over-year, but sequentially, if you kind of break that down sequentially, you're not seeing the same growth. You're seeing a few percent a quarter. You're seeing 1.36% growth sequentially, even though it's 35% on an annual basis. Whereas last year in 2014, you were seeing, 14% on average sequential growth. So that was kind of some of the evidence. Now, again, it's not everything that these guys spend. It doesn't all go to NVIDIA, but it is interesting. There is some correlation, and it goes to the correlation. So where are we here? Yeah, so I just kind of same numbers here, where you're looking at on the right, the NVIDIA revenue, kind of the blue line kind of continuing to grow, and then the CapEx of the customers in red, and then you see the percent. The percentage of the spend used to be 20%. It's going to be, 70, 80%. So I don't think that's going to happen, is what I'm saying. I'm thinking one of these two things has to be wrong. This is like 2 years of forward consensus, 25 and 26. So either their CapEx isn't gonna, is gonna grow more, or the revenue is gonna be less, right? I just don't see them get into that high of a percent spend. So it's already been tremendous growth, right? It's grown last 2 years, right? 32 billion a quarter to 65 from the top 4 guys. So there's been a tremendous, and the stocks worked and it was fine. But this year now you're seeing the stocks crack. Hey, stop spending so much. What's your return? The narrative is changing. So, yeah, and the real ones where you're seeing the flattening is Microsoft. They announced their new budget. They will. I mean, I think last time the people actually thought the growth was going to be cut in CapEx because they see all these lease cancellations, but it doesn't have to get cut. It just has to grow at a slower rate. I still think it grows. But if you look sequentially, the Microsofts and Amazon were starting to get flat. I mean, Google's still ramping, so is Meta. Meta actually increased their CapEx. But it's not just everyone's blowing their brains out anymore. You got a little bit of rational spending from 2 of them. But there are other people, like you said, sovereigns, data centers, other people want the chips. And that's the question. If half of your spending gets a little more rational, can other people step in fill this 4 billion a quarter growth rate. So yeah, so this is Amazon and Microsoft. You kind of see the growth rate going from, call it 20 to 40, and then, these are consensus numbers, right? Kind of flattening out here. So that's, yeah. So it's not all negative. Like when Microsoft canceled their leases, they're like, well, we've always done this. Like you guys just start to pay attention now. We cancel here, we add here, and I heard Meta picked up those leases. So, the media kind of picks on things. And Microsoft also did say, there's a shift to, our spend, our mix is going to change. Like we're going to do more GPU, CPU that we can monetize versus heavy data center, cement stuff. So, you have to be honest, not every data point is negative. You got to kind of say, hey, you're going to get some positives and negatives along the way. Some support your thesis, some don't. And yeah, I mean, I think there was just a lot of momentum in the back half of the year, right? The revisions to their CapEx. This is consensus CapEx numbers, not NVIDIA revenue, but their CapEx numbers for these big four was actually revised up, by 28% or so. And that's essentially NVIDIA's revenue, but that was in the back, the last 6 months here. So it went from 230 to 300 billion. And I thought that got some good press. And then Microsoft, like I said, Meta did increase it, which I was surprised on. Yeah, and then year to date, I think one of the things that happens is the street will reward if they're rewarding the customers for spending their brains out, they'll keep doing it. If they stop rewarding them, like they have this year, the Mag 7, they're not rewarding them for spending their brains out. Eventually the board gets the message. So yeah, I'm just digging into here, just not just the CapEx, but what's their free cash flow, what's the net income. So what you've actually seen here is these companies have started to spend a lot more CapEx, but their DNA, it's going to hit their margin, essentially, is what's happening, because they're now much heavier on the DNA. So you've seen they're also playing games with not necessarily games, but they're increasing the life of the assets too, so that the free cash flow revision, it's hidden. Net income is not being impacted the same way free cash flow is, put it that way, because they're spending the money and they're increasing their CapEx, but they're not seeing the increase in net income in the revision. So it's hitting the free cash flow. So I always take everything to free cash, not just net income, just because of that. And you've started to, see those revisions where the free cash flow for Amazon, Microsoft, and that's what the street is reacting to. Why is your free cash going the wrong way? And net income is actually staying fine. NVIDIA hasn't been that way. NVIDIA's in positive free cash and positive net income. They don't have a lot of CapEx. So anyway, so that's what I think is going on underneath the surface. So this is what we talked about earlier, was can someone step in? This one really shows it. The CapEx sequentially of the top 4 customers is the blue, and then the red is the NVIDIA sequential revenue increase in 24. A little lumpy, but you kind of get even things. But in 25, the street has the red bars versus look at the blue bars for the customer spend. It's a lot higher percent capture for them to get to the street's expectation. Again, we're not saying NVIDIA is a bad company. We're just saying the street's expectations are too high for them to continue to grow 4 to 5 billion a quarter with their major customers slowing up a little bit. So again, you'll see that the sum of the quarters on the left for 24 versus 25 is essentially, what I'm saying is, the big tech CapEx is going to slow from 29 billion increase in 24. Well, that CapEx is only going to be a 9 billion increase in 25. Well, the street still expects the same amount of NVIDIA revenue to be up 17 billion and then 19 billion. So someone else has got to fill that gap unless the mix shifts dramatically. So again, it's just tough bar. And then we're kind of here talking about, like, you try and get into what is the revenue per GPU per hour, the rental price. Now, some of these go out on multi-year deals, but some of them are in the spot market. And you've seen that decline. Now, some of that declines it's a natural depreciation of the asset. And we'll have more of that in a HydroHost episode. But there's also a lot of tightness in the market a couple of years ago. So So I like to have funny memes to entertain myself. So I'm like, well, is this a canary in the coal mine, kind of the softness in this leading edge pricing? Could be. But it's also there's also when you add a new chip, the new technology comes in at a higher price and the old ones depreciate. So it's not like it's the same commodity, right? Once you get the new one, everything else I won't say it becomes obsolete, but like there's a high, it's technology, so there's a quick obsolescence, right? Or someone else might use it somewhere else, but it's also an energy efficiency thing. And then what are the kind of catalysts here? You have the Microsoft CapEx. Everyone's eyes are going to be on that in July. They're one of the bigger customers. Now you also had them not kind of re-up with OpenAI. So OpenAI kind of went right to CoreWeave. So that's important. And then you also have, I should add, Meta actually increased their CapEx for 25. Amazon, they've been roughly flat sequentially on their CapEx. Now Amazon's in a little trickier spot because they're almost mostly an external cloud person, whereas Microsoft and Google use a lot of internal capacity. So yeah, and then the question is, it's really the financing, and you still see good financing. Like the OpenAI, they just got what, $40 billion. So if people are still willing to finance the customers, OpenAI and everyone else, the money will keep flowing. So that's kind of the tip there. So, but overall, I kind of highlighted in January, like I think the narrative will shift from, hey, we're in a shortage to, hey, there's some competition out there, and that'll start weighing on the multiple. We started to see that happen already this year. It obviously came right back, so now looks like it didn't happen. And then eventually, for either way, it'll depend on earnings revisions. Not hitting consensus won't be enough. It'll stay here. Is our revisions going up 10% or down? And that's going to be the key. And that'll be customer CapEx and that. So that's, you can have your opinion, but that's what I think will ultimately matter. And then I also put in, there's this NYU professor who's considered like the valuation guru. He kind of has his own little DCF out there too that I highlighted here. The value's gone. He took his down right after DeepSeek to 78 from 87, sold half his position. But everyone's got their own opinion. He kind of did a fundamental DCF as well. I think when you do these DCFs, I think a lot of people, it's the margin, right? People are just going to kind of assume the same margin, number one. The other thing they're going to assume is a lot of the value is in the terminal value. But how much do people really know what's going to happen in technology in 10 years? Are they still going to have the best chip? I have no idea. So it's kind of fun with math when you start thinking about it, how much is in the terminal value. But and then we kind of go into corporate governance a little bit. It's actually not the best corporate governance, but no one cares because he's done so well, made everyone so much money. Let me see if there's anything else. So yeah, and then kind of at the end, I kind of score it. Did you talk about what action you want the PM to take? I'm biased. I have a short position, but most people are probably long. And do I understand it? A little bit, right? I mean, who here is really a semi-expert? But I think that's one of the problems here is you kind of have this cyclical framework. And the problem is that everyone who covers it on Wall Street, those whatever 60 analysts, they're all semi-analysts. Well, this is the best semi company. So it's a buy relative to those 40 names. Well, some people have a bit longer perspective over what's going on in the cycle and other valuations. So everyone kind of has a position in this just by owning the market. So is it available at a reasonable price? The multiple, in the mid to high 20s, that's a little rich for me personally. I don't want a 3% yield for a company that I think is kind of toppy. Some people say, well, it's cheaper than it used to be versus history, so it's good. But that's, I have a high bar. I'm pretty cheap. Is the stock mispriced? I think it's a little more cyclical than people realize. And that was my take. The variant view, obviously the street's super bullish. Evidence, we've gone over a bunch of evidence here of, new competition, price on the GPUs, China risk. We can have the catalyst. You're gonna have to look at the customer CapEx and earnings revisions. If on the short side, if the bet's right, yeah, there's downside. It could go to 60, $80. I sold puts at 80 to 90. That's kind of where my rubber meets the road. And, if things continue and they get a 30 multiple on the street number, yeah, you could be looking at 170, 180. And if it's AI to the moon, they're getting high margins on stuff. So um, that's kind of the two sides of the bet. And yeah, so happy to take questions. I do have to run in a couple minutes here, and definitely feel free to go to pitchthepm.com and sign up for my newsletter. I talked about Zoom last week, and I put in one of my what I call 20 punch cards. Like what essentially I'm doing is saying, hey, if I like Buffett always says, if you had 20 punch cards investments to make for your whole life, so I put one out in there in those newsletters, and yeah, so just trying to raise my bar. And there's I have long only friends here who love this thing, and they're just like, this is how you just own great companies, and it's a great company. But I have that cyclical bias to me, and I also wasn't long it, so maybe that's my bias on the downside. But I do see some evidence of competition and a little bit of hot air. So again, not investment advice, but I put my chips where I put them, and if you own it, I don't want, you do what's comfortable for you. And, feel free to ping me. I have an apprentice group that we run on every 2 weeks. Sign up on LinkedIn, and I put out a lot of fun stuff. And I just love talking to people who are passionate about investing. So happy to compare notes. Turn it back to you, Saket.
Hey, Doug, one fun question, and then we'll let you go. What's given your hedge fund background? How crowded do you think this name is? Is everybody long? Are some famous hedge fund managers who are trying to short the stock? I know, Druckenmiller Miller was short. He was maybe a little early, but what are you hearing from?
Hey, we want to thank you so much for taking a moment to be with us, and people who follow you and follow us. It means a lot. Our whole purpose here is to empower investors. I think you've done that today, so hats off to you with some powerful tools and information. We'd like to think that we supply that in certain ways within our company, and just appreciate being a part of your company, and just appreciate being a part of your story. Look forward to seeing you more.
Absolutely. And it's always a pleasure to, work with old friends. And so we'll be in touch. Thanks, guys.
Thanks, guys.
Yeah, guys, appreciate
Thanks,
it.
everyone.
Hey, guys.
hScore, your data-driven edge in investing.